a lot of these European companies were really deriving their growth from the Chinese consumer. And so when we started to see sort of missteps in execution for that, I mean, another good example is actually Estee Lauder, of course, which we've seen sort of down 80% from the highs, but, partially due to that sort of misstep in China. It was almost a perfect storm for L'Oreal and LVMH because they were trading at such exceptionally high valuations for the growth they had to offer. So they were really discounting a sort of rosy outcome. Now we've seen massive underperformance from those shares, and I think that was due because of the valuations they were trading on. In terms of LVMH, we do actually see about 15% upside to intrinsic value, but what we want to see is just some more confidence in the improvement in the Chinese consumer, on that side of the business. And I think it's still, they're not trading on that greater, valuation. They're still on around sort of 4% free cash flow yield, 4 or 5% free cash flow yield. So I think we would just need a larger margin of safety for us to be able to get involved in that part of the market before we go there.
I have to ask you, how are you reading the latest headlines around the higher bond yields? How is this impacting your positioning of the portfolio? And do you think this could actually be one of the biggest risks for stock investing in 2025?
Yeah, so again, another great question. I think that we must really be cognizant of valuations where we are. I mean, we've had an exceptionally strong 2 years, especially in the US market, up over 20%. And I think that now it's just a really good time to be, very careful with stock selection. So, your risk-free rate is now very high. Your sort of equity risk premium is very, very low. And so, investors are not being compensated very well for holding stocks versus bonds. But the narrow market environment that we've had in the US over the past 2 years that's become really to extreme levels means that we've had a good number of stocks that have been lagging that market, like CME, like UNH, for example, really underperformed. And during that time, they've demonstrably grown their earnings and their valuations have increased. So, for now, I really believe that it's the time for active managers. It's the time for stock selectors. You can set yourself aside and increase your return expectations versus a more expensive market on a headline level.